Hello everyone, welcome back to my channel where I speak about my investments and track my net worth. In today's video, I'm going to be doing a comprehensive overview of my investment portfolio, which is currently sitting at about $72,000. The brokerage I use is M1 Finance. I find it a very simple brokerage that allows me to invest the way I want. It is very good for dollar cost average investors. And to make everything a little bit more simple, I do use the app Stock Events, which basically consolidates all of my investment holdings to make it a little bit easier to track. And before I get into my investment portfolio, please consider liking and subscribing if you do like content like this. I do make videos regarding different types of investments and all things personal finance. So overall, my portfolio is extremely simple. It consists of 4 ETFs. It is the VIG, Vanguard Dividend Appreciation ETF, SCHD, which is the Schwab US Dividend Equity ETF, QQQ, which is the Invesco QQ Trust ETF, and JEPI, which is the JP Morgan Equity Premium Income ETF. Now within my brokerage, I have 2 separate accounts. One's a blend account, which is more so for growth. It consists of VIG and QQQ. These are a dividend growth ETF and an ETF that tracks the NASDAQ. Just a quick overview before we get more into depth. And then I also have a dividend ETF portfolio, which consists of the other 2 ETFs that I mentioned prior, which is SCHD and JEPI. So I did it like this because if I ever feel like I want to invest more into dividends, I can just put it into this portfolio, these kind of holdings instead, this allocation instead. And if I wanted to do more so growth, then I can basically put my money into the blend portfolio instead, which is kind of more so what I do at the moment because I am younger and I do want a bit more growth instead of dividends currently. So before I get into the true in-depth breakdown, this is kind of an overview of each ETF from the fund page of each ETF. So VIG seeks to track the performance of the S&P US Dividend Growers Index. It is, of course, passively managed. And as simply put from the page of the S&P US Dividend Growers Index, the S&P US Dividend Growers Index is designed to measure the performance of U.S. companies that have followed a policy of consistently increasing their dividends every year for at least 10 consecutive years. The fund also excludes the top 25% highest yielding eligible companies. So this is not going to include high yielding dividend stocks. This is going to include more so dividend growth stocks, of course, with this 10 consecutive years of growing dividends. Now, if we scroll down, we do see that this ETF does include some holdings that are a bit on the higher side. I think that that's related to a possible tracking error, but we can see that the fund is truly diversified. It invests in multiple sectors without really any sort of discrimination, and the top holdings here, as we could see, are diversified, all well-known: Microsoft, Apple, Exxon, and so on and so forth. Of course, you have tech, you have energy, you have healthcare, finances, like payment technology, and looks like some semis. So again, overall, very diversified. Some great companies in there that have all had a history of growing their dividends and are all well established. SCHD, or the Schwab US Dividend Equity ETF, is an extremely popular ETF. The fund's goal is to track as closely as possible before tax and expenses the total return of the Dow Jones US Dividend 100 Index. So from the index page, that index is simply described as the Dow Jones US Dividend 100 Index is designed to measure the performance of high-yielding dividend stocks in the U.S. with a record of consistently paying dividends selected for fundamental strength relative to their peers. So not only does this index and fund track high dividend paying stocks, but it further filters them down based on various financial ratios. And I'm not going to get into the actual way it selects, because there are a lot other videos to discuss that, and I actually did a video a few months ago that did describe it, but this is kind of just a quick overview. It basically selects companies that have high yielding dividends and then further narrows that down based on financial ratios. Now, the fund is somewhat similar to VIG in that it is diversified. However, it is a bit less diversified. It only consists of about 100 holdings. So each holding here is going to be significantly more as a percent in the ETF. But all of these companies are quality. You do see many quality companies in here. You have Coca-Cola, Verizon, Pepsi, Cisco, and Home Depot, so on and so forth. It's diversified across many industries. And again, these holdings all pay high dividends and then were further narrowed down using financial ratios. Now, the Invesco QQQ, or as it's commonly called, the Invesco Triple Q ETF, is probably the simplest ETF to describe. It simply tracks the NASDAQ 100 index, and this is pretty much a technology-heavy index, and of course, as it tracks that, it's going to be a technology-heavy ETF. So the top 10 holdings here, pretty much all tech companies. I mean, I guess some people might say Amazon's like a retail company, but I mean, truly it's more so tech-centered with all of their services. So Amazon, Apple, Microsoft, Nvidia, Meta, formerly Facebook, Tesla, Google, Broadcom, Adobe, very tech-heavy and still quality companies if you are into tech. And now JEPI, or the JP Morgan Equity Premium Income ETF, is probably the most complex ETF that I hold, and it is probably one of the more complex ETFs out there, I suppose. Basically, it is designed to provide low volatility and high yield. It has a defensive equity portfolio that employs a time-tested, bottom-up fundamental research process with stock selection based on our proprietary risk-adjusted stock ratings. That is a whole bunch of words to say that it basically selects low volatility stocks that are good. Now, it also kind of operates as a covered call fund, but it doesn't really sell covered calls on the holdings because it's not designed to do that. It's designed to sell calls on the S&P 500. And it kind of does that in an unusual way. I'm not kind of going to get into that too much at the time because I already made another video again a few months back, and there are also other videos out there that speak more in depth about how this fund operates. I guess just keep in mind that it is designed for low volatility and high income. And if we look at these holdings, we can see that all of these holdings are, of course, pretty much well established. Again, these were all designed for low volatility with the benefit of growth. So overall, the fund does kind of lag the S&P 500 in some regards because it pays you dividends instead of capital appreciation. It's more so about monthly income more than capital growth. Now, I have these holdings, and if we were to really put them in a pie graph, you're going to see that they're not equal. Like, this is not an equal basis portfolio. So the most I have invested is in VIG, and that's about 38,000, and then it's descending order here. So SCHD, QQQ, and JEPI is going to be the ETF that holds the least of my money. So I'm going to bring up a chart here and kind of show you how it all breaks down. It's going to be really interesting for you to see. So this was kind of tedious to do, but what I did was I took the top 10 holdings of each ETF and put them in a chart, and I also put the weighting on top. So this was a couple days ago that I did this, so there might be some tracking error, but 45.6% of my portfolio is in VIG, 20.9% is in SCHD, 19.6% in QQQ, and 13.9% in JEPI. Now, here is a decimal style of the percentage of how much Microsoft is in VIG. So VIG holds 4.87% Microsoft. Now, I basically did a little equation here to basically break down how much Microsoft in relation to my portfolio this would hold. So VIG accounts for 2.221% of my Microsoft holdings, and then that's the same for each holding. I basically broke it down, applied that equation, and so on and so forth. So like there's 4.34% of Apple in VIG, so that equates to 1.979%. Now, again, I did this for every ETF that I had, and this is only the top 10, and then I added, if you see, the overlapping holdings together to get my overall holdings of Microsoft and Apple and all the other holdings that I have, and added them up and then made them into this chart. So how my portfolio breaks down is very interesting, and I'm going to kind of go over them one by one. So my portfolio consists of 4.5% Microsoft, let's just call it, 4.1% Apple, about 2.6% Broadcom, United Healthcare 1.7%, ExxonMobil about 1.6%, JP Morgan Chase about 1.4%, Visa about 1.4%, Amazon pretty much the same thing, 1.4%, MasterCard 1.3%, and Johnson & Johnson 1.2%. Now, there might be a little bit of difference if I were to kind of bring these down more and do the top 20 holdings instead. There might be some overlapping holdings, like within like 16, 17, 18 number holdings, and then SCHD probably has it as they're both, like, they track dividend companies. So there might be some nominal tracking error with this, but using the top 10, this is pretty much as close as I want to get it, and I feel comfortable with as much as it is there. Now, I put an overlay too, or not an overlay, but a chart rather, of the holdings of the S&P 500, the top 10, and I basically use the Spider S&P 500 ETF that tracks the S&P 500 as the comparison. And we do see overlapping holdings. We see, of course, Apple and Microsoft, Exxon and Mobil, and Amazon. They're all in the top 10 of the S&P 500 too. Now, the interesting thing, though, that is if you look at it, my portfolio is only consisting of the top 10%, is only 21% of the overall amount. So this top 10%, this top 10 is only 21% of the portfolio. Now, the S&P 500, you see, is weighted much more heavily to the top, where it's about 30% for the top 10 companies. So the S&P 500 seems a bit more, or a bit less diversified rather than my portfolio. And we also see that Microsoft and Apple are less as a percentage, and Exxon and Mobil is more, and Amazon is less. So if you look at the other holdings here, except maybe BRKB, which is Berkshire Hathaway, and even that's debatable because 40% or so of that company, of that fund, is Apple. So even that's kind of like a tech-heavy investment. You see all of these companies, NVIDIA, Google, Tesla, Meta, and this is Google again. These are all tech companies, and the S&P 500, pretty much for the entire top except Exxon and Mobil, which is rather nominal, consists of heavy technology weighting. Now, I understand that technology is a big part of the American economy, global economy, but this kind of worries me because if something were to happen to the technology sector, the S&P 500 would be adversely affected. Now, compare that to my portfolio, which does have tech at the top, and the difference is that I have Broadcom, which is a semiconductor company, and there is no Broadcom in the S&P 500, at least at the top 10. And then the remainder of my companies are not really tech at all. You can, I guess, make an argument that, of course, Amazon's kind of tech, and Visa and MasterCard are they're like financial technologies, but they're really payment services. They are tech centered, but they operate in a different way than technology companies do. And we see United Healthcare, Exxon and Mobil, Chase Bank, and Visa, MasterCard, and Johnson & Johnson. So my holdings here are a lot less centered on technology companies, and I really do like that because it gives me quite a bit more diversification than anybody that just invests in the S&P 500. And this might not do well for me regarding growth, but I am comfortable with all of these companies in the top 10. They're all solid, and based on the investment methodology of these ETFs, these are all pretty much dividend growth companies that have a solid track record. Now, of course, I purposefully picked these ETFs because they all kind of invest in a different investment methodology. VIG and SCHD, of course, both pay dividends, but their investment methodology is different, and that allows for quite a bit different holdings, at least in the top 10. You see that there's only one comparable holding, and then QQQ is a tech heavy, so there's basically no comparable holdings except the Broadcom, and then JEPI has its own selection method, which has a bit of different diversity than the others. And what we get is a portfolio that kind of complements each other very well. There's a good amount of diversification that doesn't get overly overlapping holdings. And what I mean by that is we see some investors kind of invest in companies that have a lot of overlap, and this is kind of a bad example for a portfolio because I think he's very heavy on individual stocks. But that's beside the point. There's probably quite a bit of overlap between DGRO and also the Vanguard S&P 500 and SCHD. They both seem to use the same type of investment methodology in some regards, although DGRO I think is more like my VIG. And including VU, an ETF that tracks the S&P 500 at 15%, there's kind of no point to it. It doesn't really seem that a portfolio like this has much direction. Is the purpose to track the S&P 500? Is it for dividends? I'm not really sure what this is. It looks like he wants some individual stocks here too. Realty Income, which is a growth company, and I think this is Raytheon, which is like an aerospace defense company. If we go back to my portfolio, we do see some overlap, but the overlap complements very well. I think there's quite a bit of overlap in some of these, at least at the top, but each one has a different methodology, and it all combines to something that is different than the S&P 500, which I, again, really like. Alright everyone, I hope that this video gave you some insights into different ETFs. This is a very simple portfolio that I think everybody can easily replicate if they are interested in this kind of investment style. And again, if you did enjoy this content or content like it, please give this video a like and consider subscribing. It will be greatly appreciated. And in the next video, I am going to be speaking to you about my net worth update. It's been a few months since I did that, so I want to do another video kind of to show you all how it's been going. Thank you all, and have a great day.